We see Russia as a really interesting turnaround opportunity. So going back a little, basically in 2014, we saw a perfect storm hit Russia. Oil fell to $34 a barrel, and then we saw the annexation of Crimea and the involvement of Russia in the Syrian civil war, and that led to pretty draconian sanctions from both the United States and the European Union. And the key question is, how did Russia respond? So first we saw the response in regards to monetary policy. Yes, there was a lot of pressure on the currency because of all of this, and they allowed the currency to float, and that created a lot of pressure. The ruble weakened from 34 rubles per dollar to 86 rubles per dollar, and that translated into a significant amount of inflation. Inflation spiked up to close to 16-17%. From that, the central bank prudently and independently raised interest rates to curb inflation. Interest rates came up from 6% to 17%, and that put some pressure on growth, but lower growth also led to lower inflation. And then we also saw our carry trade coming into Russia, which supported the ruble and started bringing inflation down, which allowed the central bank to cut interest rates again and drive growth. So since 2015, we've seen the Russian central bank cut interest rates by 925 basis points, and that leads to lower net interest expenses and positive earnings revisions. In addition to monetary policy, we've seen a really strong fiscal response. So Russia has become a counter-cyclical player in emerging markets, which is very different from where we were 2 years ago. That's come primarily through something called the budget rule that they implemented, and though Russia used to be, for lack of better words, a proxy. Russian assets were a proxy for oil prices. And now with the budget rule, as oil prices rise, the government is buying dollars and selling rubles and doing the inverse policy as oil prices drop. So that creates a layer of stability for the currency, and in addition to that, gives us stability for the fiscal balance of the country. A couple of years ago, we had a 3.9% fiscal deficit in Russia. Now we're looking at a 2% fiscal surplus for the end of this year. So that kind of shows that this is really working. That said, we had a great monetary policy response, we had a great fiscal policy response, but we're still living in a world of sanctions. But the thing is that that's okay. We have been doing so for the past 5 years. So Russia's learned how to operate in a sanctioned world. They've implemented import substitution industrialization. They're now seeing positive growth, low inflation, a fiscal surplus, a current account surplus, single-digit unemployment rates, single-digit inflation, and easing monetary policy. So you have all these drivers really pushing Russia, yet we're still trading at very depressed valuations. Russia's currently trading at 0.8 times price to book, 6 times earnings, and a 7.5% dividend yield. And yes, that is all attractive by itself, but in addition to that, over the past 5 years, Russian corporates have really delevered. So we're looking at net debt to equity levels below 20%. And that is, from our opinion, is really inefficient from a capital structure perspective. So we think that that creates a catalyst looking forward, that Russian corporates are going to continue to return money back to shareholders, which will increase dividend yields, and that means asset prices should chase those yields. And in addition to that, as they continue to lever up again, that's going to improve your average cost of capital and give you a potential multiple re-rating as people are going to look at valuations in a much more attractive lens.